Okay, so let's take a look at our first deferral adjustment. And before we consider the adjustment itself, let's talk about the difference between deferrals and accruals. Deferrals are categorized as a different type of adjustment than accruals, and it's totally based on the timing of a cash transaction that's happening. Now, I've already told you cash is not involved in the adjustment process, and cash will not be one of the accounts that we debit or credit. But what makes a deferral is that there has been some cash transaction that's already happened in the past, and at that time we waited or deferred recognition of revenue or expense because GAAP said it wasn't time to call it a revenue or expense. It's the adjustment phase where we're considering whether we need to record a revenue or expense. So with all deferrals, there's been some cash transaction first, and in the adjustment phase, we're recognizing a revenue or expense. Conversely, with the accruals, we're recognizing revenues or expense first, and then after the adjustment phase, at some point in a new accounting period, we're having a cash transaction that follows that. So it's the timing of the cash transaction really that dictates which type of adjustment it is that we're talking about. So supplies is a really great example of a deferral kind of adjustment because we purchase supplies and we put them in an asset account, and then later we come back and figure out how much of that asset we've used up. And typically that's during the adjustment phase that we're going to recognize supplies expense. And that's exactly what we're going to be doing here. So we found that we go count our inventory of supplies, and we find that there's only $400 of supplies left. But if we actually look in our accounting records at the amount we have in supplies, we have a balance of $1,230. So supplies is an asset, and we said assets have normal debit balances. If the balance in this account is $1,230, that's what the T account looks like right now. And what we want the T account to do is we want the T account or the balance in supplies to reflect what we really have. If we have $400 worth of supplies on hand, that's our desired ending balance. This is where we want to get to. Okay? So in our adjustment, we are going to be making supplies go down, and that decrease in supplies represents an expense because we've used up those supplies. So if we want to think about the transaction analysis side of this, on the income statement we have revenues and expenses, and we've already talked about how when expenses go up, we have a corresponding decrease to our retained earnings. That's the impact of what's going to happen there. So retained earnings is going to come down because we have an expense. And we've looked at the supplies account. Supplies is an asset. We know that supplies as an asset needs to come down. So we want to achieve our supplies asset and achieve that decreased balance of $400. The only way to do that is to credit that account by $830. So the amount of our transaction is going to be for $830 because it takes $830 of a credit to make that $1,230 debit balance decrease to $400. And that also means that the change in retained earnings and the amount of expense is going to be $830 as well. So let's put debits and credits to that. We have an expense. When we make expenses go up, we need to debit those accounts. So supplies expense needs to be debited for $830. That's the amount of our change or transaction. Those are the amount of supplies that we used up. That's what supplies expense needs to get. Our asset account called supplies is being decreased with that credit for $830. And when we make this adjustment, we have achieved our objective here of getting that account balance to match exactly what we have in supplies. Okay, so our next deferral adjustment has to do with unearned revenue. If there's one account that gives students the most trouble, it's this account called unearned revenue because it just has a weird title and it has the word revenue in it, which makes you think it's a revenue, but it's not because it represents unearned revenue. So we're hearing that we have earned all $3,500 of the unearned revenue that we have. So let's think about the unearned revenue account. How do we get unearned revenue in the first place? Well, what happens is that we have received money from a client before we've earned the revenue. And so unearned revenue is actually a liability. It's an obligation to us. It's like a prepayment that we've received, and we have yet to deliver either goods or services to our client. So if we have unearned revenue, it means that somebody has paid us $3,500 already, and we owe them a service. So now we're being told that this obligation to provide this service has been satisfied because we've earned it. Okay? So unearned revenue has a normal credit balance because it's an obligation. And so that would be the way that the unearned revenue account is appearing before we do anything at all. So earning revenue, hopefully that helps us realize that this is talking about, if we've earned revenue, this is talking about revenue on the income statement, right? And we need to make our revenues go up. And when we do, those revenues push up net income and they make our retained earnings go up. Now, here they're telling us that we've earned all of this. So in this particular case, our retained earnings is going up because we have $3,500 of revenue there. Now, unearned revenue is a liability, and we need to satisfy this liability. We no longer owe these services to our client because we've earned them. So we need to decrease this obligation called unearned revenue. So unearned revenue is going to decrease by the amount of revenue that we're earning, and we're going to end up eliminating that balance that we have in the liability account. So nothing is happening under assets at all. Our resources aren't improving as a result of this adjustment. We simply want to wipe away this obligation that we have on our books and now move that to be recorded revenue according to GAAP. And when we do, we're going to be debiting unearned revenue because that liability is going away. And that's really the only way that we're getting that unearned revenue account to be down to zero, which is what we want. So unearned revenue is our debit here. We're decreasing that liability with a debit, and the amount of the debit would be $3,500. And because we've earned the revenue now, we would be crediting the service revenue account. And this credit would make the service revenue increase. Okay, so our last type of deferral that I'd like to look at has to do with depreciation. And depreciation is kind of a different animal, so it's probably a good idea to talk about what depreciation relates to and how we account for it. So depreciation is a special word that we use to capture the using up of our long-lived productive assets. So that's a really long explanation for saying anytime we have an asset that we're using to make money, we recognize that it has a limited life, those assets have limited lives, and that over time we're actually consuming part of the productive life that it has. And when we purchase those assets, we capitalize them as an asset. So that means we record an asset. Whenever we buy machinery or buy equipment or vehicles, anything that's going to last more than one accounting period, we set that up as an asset or capitalize those amounts. And then over time, we record depreciation expense, and that depreciation expense is an estimate of the using up of that asset. So the resource or asset is increased whenever we buy it, and then over time we recognize the using up of that asset. So we're dealing with an expense here, and the expense of depreciation that we have is $233. So let's look at part of the impact on the basic accounting equation. We know that anytime we have a revenue or expense, something's going to be going on. This is an expense going up. And always, this is very consistent about accounting, when you have an expense, it's going to make retained earnings go down. And the type of expense, I'm going to just write that in, would be depreciation expense. We like to be specific and name the types of expenses that we have so that we can track those expenses. We wouldn't want to put all of our expenses in one big category that's just expense, because then we wouldn't know what the makeup of those expenses were, and we want to know more about what the things that we use up. So we'll use depreciation expense specifically to record this $233. But again, what's special about our fixed assets, on the balance sheet, we record those fixed assets at cost, and we use an account called a contra asset. A contra anything goes against another account. It is subtracted. By nature, it is subtracted by another account. The contra account that we use for depreciation and for our property, plant, and equipment is called accumulated depreciation. So accumulated depreciation is a contra asset, which means it's going to appear on our balance sheet under assets. But what's really weird about it is that because it's a contra, because of its contrary nature, it's going to have a credit balance in it. Okay? So when we look at the balance sheet and we look at our property, plant, and equipment, which is what depreciation relates to, when we look at our balance sheet, we can see, oh, we paid this amount for our equipment, and accumulated depreciation would represent the cumulative amount of that asset that we've used up. And so that's how that account is used. So our two accounts to record this transaction are going to be expense and accumulated depreciation. And because accumulated depreciation works against our assets, as it goes up, it's going to bring our assets down. Okay, so assets are coming down as a result of accumulated depreciation, but accumulated depreciation itself is increasing, right? It's a deduction from our assets group, but it is pushing our assets down because it's being subtracted. Okay, so every time that we record depreciation expense, the structure of that journal entry is going to look exactly like this. We have an expense, it's called depreciation expense. We're going to debit it because expenses are always debited when they are going up. And we need to recognize additional expense related to these fixed assets of $233. Essentially what this says is we've estimated we used up $233 of those long-lived assets. And we want to get this expense in the proper accounting period. The credit is going to be to accumulated depreciation. Accumulated depreciation has a normal credit balance because it is contrary to assets. So when we credit this account, it has the effect and impact of bringing our asset group down. So when we analyze this transaction, when we record depreciation expense, the net amount of our property, plant, and equipment, we're going to refer to that as our net book value. We're going to talk more about that later in the semester, but our net book value essentially is coming down under our long-lived assets group for our resources, and expenses are driving down our equity.